But yeah, trading bullish strangles. It works. Done.
Simple. You know, come on.
No, all kidding aside, this is definitely interesting when you consider the market that we're in, the bullish market, the low VIX. What do you do in a market like this? Maybe you skew your strangles to the upside with bullish delta versus neutral.
Yes.
Maybe not. Let's figure it out. Stock markets keep moving higher despite various global uncertainties. The strength makes bullish option strategies more appealing, like selling naked puts or covered calls, which profit from upward price movement. If you've been selling puts in pretty much anything, you're doing just fine.
Free money.
Unless it's UNH or Chipotle.
There's a couple tails here and there, but...
Yeah. But SPY, QQQ, you're golden.
Yeah.
Golden.
Straight up and to the right. Looked perfect.
Yeah. So how do we optimize this or potentially optimize this? We'll take a look. When examining premium income potential, 30 delta puts typically generate higher premiums compared to 16 delta strangles over extended periods. And it makes sense. You're basically removing risk on both sides. You're shifting your risk to the downside. You're replicating your premium in the short call by moving your put higher.
Yep.
So instead of a 16 delta, you're moving it up to a 30. And we talk about that all the time. Like for earning strangles, like just get rid of one side and move the other side in. Get rid of that risk. Give yourself the ability to make money on delta versus a vol crush that might not happen until earnings.
And it plays into put skew as well.
Yep.
So, selling the 30 delta put is going to be meatier than the combined premium that you get from the 16 delta strangle, which is what you see here, the average premium of $3.80 versus the $3.10 strangle. I do want to preface this too, because you have to take, and one of the reasons why we always talk about win rate with any sort of really long back test, and we're looking 2 decades here, 20 years, a lot of data. The relative amount of premium is way different. So 10, 15 years ago, the 16 delta strangle on SPY, which was, had a 2 handle, 200, was a lot lower than the relative premium now. And so, the premium amounts skew and the P&L values skew a lot towards the here and now because the size of the market has just gotten so much bigger. You have to keep that in mind.
Yep. For those seeking upward participation while maintaining downside hedging, a bullish strangle with net positive delta would be an interesting alternative. How does this adjusted approach compare against the traditional delta neutral strangles that you can deploy in any environment? Let's take a look. We looked at 2 different 45-day SPY strangles over the past 2 decades, 16 delta strangles and 30 to 16 delta strangles leaning bullish. So shifting that put up.
Yeah.
We close all positions at the 21-day mark. Let's take a look.
Got to imagine the long delta helps you a little bit here.
It does. Bullish strangles had better returns, even though they were a bit more volatile and could lose more money on the downside, of course, because you're moving your strike higher. You take on intrinsic value risk sooner than the 16 delta strangle. The put side break even's closer, so market drops have more impact. Return on capital was better than neutral strangles simply because if your put has more premium there and you're not tested as much or as frequently on the downside, you're going to make more money with the juicier short put. Simple as that.
Yes. Yeah. The success rates being just about the same is interesting, which wouldn't be a shock. I mean, you're getting paid more on the 30 delta put and the 16 delta call. That's a meatier position, so you're going to have a much higher return on capital. But you can see your everything else is basically the same here. There's been a bullish skew, but it's stayed relatively range bound between the standard deviation.
Yeah. And it's not about where the short call is, it's about where your short put is, which is why your return on capital volatility is lower with the neutral strangle. Your largest loss is lower with the neutral strangle.
Yes.
But you would have made more if you leaned a little bullish into a market that is bullish.
Yes.
Makes sense.
Not a shock.
Yep.
Yes.
Next slide, we compare the bullish strangles to just selling 30 delta puts. The strangle made less money and had a lower win rate. The call side reduced the profits naturally. The strangle was less volatile and had smaller maximum losses. It's a compromise that gives us some upside while controlling risk better than the naked puts. So, I'm still leaning in the boat of you should always analyze both sides of the trade, right?
Yeah.
If you have a short call on, make sure it's worthwhile. Make sure the premium's there. It can help you in terms of risk management for sure. But in a lot of cases, if you want to lean bullish, maybe you just go with a short put, or especially in earnings cases. Like SPY is different, but especially in earnings cases, I think this is a case to make for maybe ditching one side, just leaning bullish or bearish if you wanted to.
Yeah.
But interesting to see the premium is much lower with just the short put. Success rate about the same, higher success rate in a bullish market, of course, but definitely lower return on capital volatility, and your largest loss is slightly lower with the strangle because you have that short call premium.
Yeah. I mean, we know obviously that the market has gone up significantly, and it has certainly been a mostly upside move. But we know from experience, as well as just customers that tweet in or chat in or email in, it's easy to sell the puts and have no problems all the way up. And then when something happens and there's a 1% down move or a sustained down move, that's when everybody gets a little freaked out and has some issues. And so, I know that you're hitting a higher profit with just one side, but you can see selling both sides, although you don't, have as high a return on capital, your P&L volatility is reduced. Your biggest losses are reduced, which, when what seems like 90% of the time the market is up, seems like why would I ever have anything on the upside? It does come into play in terms of reducing your overall volatility of returns in both directions, which over a long period of time is very, very helpful because you're going to go through periods where the shit hits the fan. So you can't always just look at like the highest upside. We get that question all the time of like, I'm bullish here. What's the highest upside? And it's like, well, the highest upside is going to have lower probability. You need more of a directional move. I mean, anytime you have higher upside reward, it's going to be a lower probability trade. And so, there's always that push and pull.
Yeah. And like we've talked about as well, the most important thing is trading small and having a sustainable strategy. And
yes.
Both of these, regardless of which one you choose, both of these are sustainable strategies.
One's not better than the other.
Yeah.
That's the point.
It's different depending on the market scenario that you're in.
Yeah.
But I think this also shows that you can have a short put on, you can have a neutral strangle, you can have a bullish strangle. They're all going to be decent trades over time as long as you are trading small enough to where you can maintain and withstand any variance.
Yes. When you look at the largest loss numbers, you will see that.
Unless, of course, try to fade the Fed, which is what we're going to talk about in the next slide. So to complete the picture, we also looked at bearish strangles for comparison. We flipped the deltas from bullish to bearish in the same market environment. And these ones didn't do so hot. So bearish strangles underperformed both alternatives while showing the lowest volatility among all three approaches. The returns were below expectations. The strategy appears better suited for traders holding bearish market assumptions. Now, what's interesting is the success rate is lower, of course, if you have a 30 delta short call and a 16 delta short put.
Yes.
Return on capital volatility was the lowest of these three. And the largest loss was the lowest. Now, why is that? Stair step up, elevator down.
Yes. So your losses are much smaller relative to the other sets, which means that your distribution is going to be much tighter.
Yeah.
You're removing the tail or some of the tail.
Yeah. You still made a little bit annualized return on capital, leaning short, but I think it brings in the question of like, what is the objective of a strangle? It's to have time pass, volatility collapse, and have the market stay within your range.
Mm-hmm.
Where does that happen the most on a frequency basis? In low IV environments when the market's chopping around and maybe we're drifting higher slowly. This is why you're seeing better results with the bullish strangle versus a bearish strangle. And even in a bearish strangle environment, if the market is tanking, I don't think the bearish strangle is what you want to have on. You want to have on
diagonal spreads,
the micro static delta positions.
Yes.
So
either of these trades, even the bullish strangle of a 30 delta, 16 delta call, that's a neutral to bullish.
Yeah.
The other trade is a neutral to bearish. That's why the probabilities are working out to be positive, to be in line with what you would expect, but they're good, success rates. But that's why they're good success rates, because it's neutral. It's not purely directional.
Yep.
One way.
Totally.
Very nice. Takeaways, left side.
Couple of takeaways here. Bullish strangles have positive delta exposure, so they perform much better when markets go up consistently. We get higher returns, but also accept more volatility compared to neutral strangles. And the bullish strangles sit strategically between selling naked puts and neutral strangles, if you think about it conceptually. We get solid returns from the put side while having much better downside protection and less overall volatility than naked puts alone. Totally get it. And yeah, I think when the premium is there, it makes sense to have something on. I think you have to take this and adjust it for the environment you're in. Like in the heat of the moment in April, was I throwing on strangles and SPY? No, I was throwing on bullish trades only.
Yeah.
So it's like you have to take this for what it is and realize, okay, if there's a sharp sell-off, do I want to have upside risk if I believe there's going to be a reversal? Maybe not. Maybe that's when you go with the short puts for a couple months. Now the VIX is in the teens. It's a much better environment to have the neutral strangles on or the bullish leaning strangles on, in my opinion, because now we're at highs. I think it's going to be harder for us to just continue to rip higher. We might grind higher over time, but a strangle is going to be beneficial to that if that's the case.
We're buy the dippers, though, as Tom would say.
We are.
We just buy the dip.
We are silly
millennial traders. They just buy the dip. Worst thing ever. Good stuff.
But yeah, good one.
That was great.
If you're not subscribed, subscribe right here. And if you want to meet me and the team in person at our next live event, hit the link at the top of the description.